Okay, here's a thought. What if some of the most brilliant innovations, the stuff billions report into, what if they aren't truly gone when a startup fails? What if they're just, well, dormant, waiting for someone to flip the switch back on? It's kind of a mind-bending question, isn't it? And it's really at the heart of our deep dive today. We're digging into a really fascinating, maybe even bold new venture idea. It comes from tech business consultant Dr. Ari Masudi, and he's looking right at this often ignored potential within what people call the tech industry's graveyard. So, our mission today, let's unpack this concept. Can we really transform failed VC-backed startups into a gold mine of intellectual property? Because this isn't just about salvaging some old code. We might be talking about a multi-billion-dollar opportunity that's been, frankly, hiding in plain sight.
Exactly. And for you listening in, especially if you're a general partner, a managing partner at a VC firm, maybe you run a family office or you're with an institutional investor backing venture funds. This is more than just a neat idea. It's potentially a whole new way of looking at things, a paradigm shift maybe. We're talking about an investment thesis that really challenges how we usually think about tech progress, how we account for failure, and maybe most importantly, where we can find value, real value creation. Think about how this could impact your fund's risk or maybe diversify your tech holdings on a totally different cost basis than, say, an early stage bet.
Right. So let's dive into that core paradox. We all know the story, right? A super smart AI startup gets, what, $10 million in VC money, burns through it, and then puff, gone. Everyone just writes it off as a loss. Another one for the startup graveyard stats. But hang on, what about the amazing algorithms they built, that innovative code, the patents they spent a fortune securing? Do they just evaporate?
That's the point. Precisely. That's the VC-backed startup graveyard we're talking about.
Mm.
It's not just companies disappearing. It's the actual intellectual property, the code, patents, trade secrets, data, research that gets left behind. And the really frustrating part, so much of this IP just sits there. It goes to waste. It's like finding gold nuggets scattered on the ground and nobody's picking them up.
And the scale here is just, wow, we hear like statistic all the time, right?
Yeah.
90% of VC-backed startups fail. But the hidden part of that story is the value left behind. We're talking an estimated $65.5 billion worth of IP assets, just abandoned, unused.
Yeah, it's staggering when you put a number on it. I mean, think about Theranos, for instance. Okay, huge collapse, total mess, but they still had a portfolio of patents and tech. Sure, some got canceled, but others were potentially legitimate, maybe usable for something else entirely. Or think about all those AI startups that fizzle out every year. They're machine learning models. The curated data sets they painstakingly built, they don't just vanish. They end up in this kind of legal limbo, just collecting digital dust. It's a huge untapped reservoir of innovation.
Okay, so this is where Dr. Masudi's idea comes in. It sounds pretty audacious. He's talking about a fund that acts like a tech scavenger. Not a bad way, maybe more like a value restore. It swoops in, buys this abandoned IP for, pennies on the dollar, and the end game, to build what he calls a Netflix-style subscription service for innovation. That's quite an analogy.
It really paints a picture, doesn't it? Imagine like a giant warehouse, but instead of stuff, it's packed with cutting-edge tech, algorithms, code bases, research data, stuff that cost millions and millions to create. Now imagine you could just rent any piece of it, like streaming a movie, but for innovation, just a flat monthly fee. That's the core idea. It's not about selling you the whole car, maybe just letting you use the engine when you need it on demand.
Okay, let's break that down a bit. Masudi lays out roughly a 3-step process, right? Step 1, treasure hunting. Becoming the IP undertakers of Silicon Valley, maybe. So actively partnering up with VCs, working with the bankruptcy lawyers, maybe even talking to the founders, finding and acquiring the patents, the code, the secrets from these companies that went under. I mean, when a startup fails, someone's got to deal with these assets anyway, right? Why not an entity that actually sees their potential value?
Exactly. Someone has to manage the liquidation.
Yeah.
This model proposes a dedicated buyer focused specifically on the IP's future potential, not just its scrap value.
Right. Then step 2, building the arsenal. All this acquired IP goes into this central innovation vault. He describes it like a searchable library, all categorized like GitHub meets Amazon, but for discarded startup genius. So it's curated, not just a pile of stuff.
Precisely. It needs to be accessible, searchable, usable, not just a digital attic.
And then step 3, democratizing innovation. This is the Netflix part. Companies pay a simple flat fee, access and licensing. And the key thing is the simplicity, right? No complex negotiations, no haggling over percentages based on how successful your product becomes using your old IP. Just straightforward pricing. So anyone, a big Fortune 500 or, a couple people in a garage can tap into this world-class tech that would normally be way out of reach.
And what's really clever here is addressing what you might call the failure paradox.
Hmm.
See, most startups don't actually fail because their tech was bad. That's often not the reason. Usually, it's other things. Timing was off, marketing flopped, they ran out of cash, maybe the founders had a falling out, you know the drill. But the actual innovations, the core tech, often brilliant, fully working, salvageable, it just couldn't find that specific market, or that business model didn't fly.
Yeah, I remember reading that anecdote in the source material. It really stuck with me. This founder built amazing computer vision algorithms for retail analytics, but then the pandemic hit, killed foot traffic, and the startup just died.
Mhm.
But those algorithms, they could be powering advanced security systems now, or factory robots, maybe even self-driving cars, but instead,
Instead, they're gathering digital cobwebs. It's a perfect description. Such a waste of potential.
which brings us to the simplicity advantage you mentioned, compared to how IP licensing usually works.
Oh yeah, traditional IP licensing can be a total nightmare. Lawyers, complex contracts, arguing over percentages for months, sometimes years. Masudi's model just cuts through all that red tape. It's like, why don't you use our fancy neural network? Okay, that's $5,000 a month, done. Designed for speed, clarity.
And that clarity, that simplicity, it also acts as this kind of David and Goliath equalizer, doesn't it? Right now, it feels like only the big players, the Googles and Amazons, can really afford to develop or license the truly cutting-edge stuff.
Absolutely. But a flat fee model changes that game entirely. Suddenly, that tiny two-person startup can access algorithms that maybe a tech giant spent millions on
Mhm.
and then shelved. It genuinely helps level the playing field for innovation, empowers the little guy.
Okay, so we've got the problem, the opportunity, this clever model. But now let's talk brass tacks. For our audience, the investors, the GTs, the LPs, what are the numbers? What makes this financially compelling?
All right, let's get into the investor perspective. And the numbers are, well, pretty compelling. First off, acquisition costs.
Hmm.
You could often pick up this failed startup IP for maybe 5 to 10 cents on the dollar of what it originally cost to develop. Think about that. Buying finished tech for a tiny fraction of its creation costs.
Wow. Okay, 5–10%.
Yeah. Second, the market itself. This whole IP licensing space, it's already huge. We mentioned that $65.5 billion number earlier, and it's growing. This isn't some tiny niche. It's a massive, established market ready for a new approach.
So the demand is there.
Definitely. Third, there's precedent. Look at Intellectual Ventures. They built a massive multi-billion-dollar patent portfolio, like $6 billion worth, based on acquiring and leveraging IP. Now, okay, their reputation got a bit complicated. Some call them patent trolls. But the financial scale they achieved, undeniable proof of concept in acquiring and monetizing IP assets.
Okay, so it can be done at scale.
And finally, you've got this explosion in demand, especially in hot areas like AI, biotech, IoT. Companies are desperate for existing IP to speed things up. They don't want to reinvent the wheel if they don't have to, especially budgets are tight.
And that calculation from the source really drove it home for me about the Reddit founder.
Oh yeah, that was a great example. He mentioned selling code from his failed venture for anywhere between $25K and maybe $1 million. So imagine this fund acquires similar code for, say, $50,000, just one piece, then licenses it out maybe $2,000 a month to just 50 different companies. Simple math. That single $50 acquisition turns into $1.2 million in annual recurring revenue.
$1.2 million ARR from one relatively small acquisition. That's serious leverage.
That's the kind of potential return we're talking about. That's the financial engine.
Okay, but it can't be that easy. There've got to be roadblocks, right? Big challenges.
Oh, absolutely. And it's crucial to face those head on. Dr. Masudi addresses them. Challenge 1, finding the diamonds in the rough. Not all failed IP is actually valuable. Some of it is junk.
Right. How do you sort the wheat from the chaff?
The solution is rigorous evaluation, partnering with real technical experts who can vet the IP, and being strategic, focusing on those high-demand sectors, AI, biotech, clean tech, where there's hunger for innovation, it needs discipline, curation.
Makes sense. But what about the legal side? Who even owns this stuff when a company tanks? Sounds like a maze.
It can be a maze. That's challenge number 2, navigating the legal complexities. Who has clear title? The solution there is working directly with the people who handle this professionally. The VC firms managing the wind down, the bankruptcy specialists, the liquidators, they untangle ownership as part of their job. And critically, Masudi suggests buying IP in bulk. That can streamline the legal process significantly compared to trying to cherry pick one patent here, one code base there. It's specialized, yes, but there are established ways to do it.
Okay, bulk buying helps streamline. And the third challenge, just running the thing. An IP marketplace sounds complex operationally.
All right, challenge 3, platform management. It does sound complicated, but the solution isn't necessarily to build everything from the ground up, reinventing the wheel. It's about leveraging existing tech platforms where it makes sense. And crucially, hiring people who already know this world, experienced IP licensing professionals. Build a better system using existing tools and expertise. Don't start from scratch on every single component.
So it seems like the timing for this might be unusually good right now. You mentioned converging trends creating a perfect storm.
Yes, the timing feels particularly potent. 3 big things are happening at once. First, what some are calling the great startup die-off. Higher interest rates, economic jitters. Sadly, it means more startups are failing now than in recent years. More failures mean, bluntly, more high-quality IP becoming available for acquisition, likely at good prices.
A bigger supply pool, essentially.
Exactly. Second, the innovation arms race is only heating up. Every company feels the pressure to innovate faster. Licensing existing, proven IP is just way faster and often cheaper than building everything in-house, especially when belts are tightening. So demand is high.
Faster time to market using existing assets.
Precisely. And third, there's this broader democratization movement, a real push to make advanced tech accessible beyond just the tech giants. This flat-fee subscription model fits right into that trend. It lowers the barrier for smaller companies to access powerful IP.
And you mentioned there's real-world proof that pieces of this model work already.
Yeah, they're interesting parallels. Look at the medicines patent pool. They pool pharma patents to make affordable drugs for developing nations. They've created huge value, saved lives. It shows the social good aspect that aggregating and licensing IP can have, even if it's in a different field.
That's a powerful example. And intellectual ventures.
Right, intellectual ventures. We mentioned their $6 billion portfolio. Whatever you think of their tactics, that patent troll label stuck for a reason. They absolutely proved you can acquire IP at scale and make serious money from it. The scale is demonstrable.
Okay, scale is possible. And the auction houses.
Like Ocean Tomo, they run live IP auctions generating millions. It shows there is a transparent, functioning market where IP assets can be valued and traded openly.
So transparency is achievable too.
Exactly. And what Missouri seems to be proposing is taking the best bits from each of these, the sort of social good and democratization for the patent pool model, the sheer scale that IV demonstrated, and the market transparency you see in auctions. Synthesize those elements, create something that's ethical, scalable, transparent, and yeah, potentially very profitable.
So let's pull this all together. The grand vision here. It's pretty inspiring, actually. A world where brilliant ideas, hard-won research, they get a second shot, right? Those AI algorithms that miss their market, maybe they become the core of the next big thing, that biotech research that ran out of money. Maybe it saves lives in a totally different way down the line.
It really is about more than just the financial return, although, as we've laid out, that potential is significant for investors looking at new ways to generate alpha or diversify. It's about building a genuine circular economy of innovation, making sure brilliant work doesn't just die on the vine, that startup graveyard. It stops being just a place of loss and becomes a source of valuable raw materials for the next wave of world-changing companies.
It definitely reframes failure, doesn't it? So for our listeners, the investors tuning in, maybe the provocative question isn't if this model could work or if it could transform things. Maybe the real question is, who is going to build it first? Who's going to recognize this hidden value and actually seize the opportunity? Well, thank you for joining us on this really fascinating deep dive into the VC-backed startup graveyard and this potential new future for IP. We hope it's given you some food for thought, a new perspective, and maybe sparked some ideas for your own investment strategies.